After a lot of groundwork, if you want to be polite about it, and jawboning if you don't, the US Federal Reserve and the Bank of England will declare their headline interest rates and quantitative easing strategies on Wednesday the 4th and Thursday the 5th of May, respectively. The Fed raised by 1/4 point to 0.5% back in March, and markets reckon a half percentage point increase to 1% is nailed on at the forthcoming meeting. Markets are also looking for further half percentage point increments at the majority of the Fed's remaining 5 policy meetings this year after this one. The CME FedWatch tool suggests that markets are pricing in an 80% chance of the headline Fed's fund rate reaching at least 3% by the end of this year. This may also be the meeting where Fed Chair Jay Powell outlines the American Central Bank's plans for quantitative tightening, or QT, as it seeks to tighten monetary policy in another way and curb the stimulus it's liberally applied since the Great Financial Crisis, which you could argue has at least laid the groundwork for a lot of the inflation we're seeing now. Mr. Powell has hinted at a rate of withdrawal of some $95 billion a month, although that does compare to a current asset base of a record $9 trillion. So far, as far as the Bank of England's concerned, markets are pricing in a 1/4 point rate rise to 1% on May the 5th, and subsequent hikes to 2.25% by the end of this year. The old lady of Threadneedle Street has, however, already gently started QT. As of the last meeting, it had taken the amount of QE applied since 2009 down to £867 billion from a peak of £895 billion. On the company front, it won't be quite as busy this week as it was last week, but it should be no less informative for that. Around a sixth of the FTSE 100's members are scheduled to release a trading update, publish results, or host an annual general meeting in the coming week, and a good few mid and small caps are due to do the same. Names which may be worthy of further study include the following, although please bear in mind some of these dates could yet be subject to change. Card Factory on Tuesday the 3rd of May, Flutter Entertainment, Direct Line, OSB, Boohoo and Aston Martin Lagonda on the 4th, Shell next, Mondi, BAE Systems, Barratt Development and Derwent London on the 5th, before International Consolidated Airways and Intercontinental Hotels round off the week on Friday the 6th of May. But the company which could just cause the biggest fuss in the week ahead is BP. The oil and gas major will report its first quarter results for 2022 on Tuesday the 3rd of May. BP shares are up by more than a third in the past 12 months. Sentiment's being helped by strong commodity prices, with Brent crude up 2/3 in the past year to around $107 a barrel as I record this, and natural gas up by more than 150% at $7 per million British thermal units. That said, BP shares are only trading at the level seen just before the pandemic broke out 2 years ago, when oil and gas prices were an awful lot lower. Perhaps investors don't think the commodity price strength will last. Perhaps they're sticking to their environmental, social and governance principles and just avoiding oil and gas stocks. And perhaps they're not that keen on the strategy outlined by Bernard Looney, the chief executive, to reposition BP for a net zero world. Either way, the shares aren't motoring along as you might expect, and all eyes will now be on the first quarter results. The headline figure will be the underlying replacement cost profit, which reflects the replacement cost of supply and excludes changes in the value of inventory. It is not, however, I must stress, a recognised statutory accounting measure. In the fourth quarter, BP racked up $4.1 billion in replacement cost profit on an underlying basis, and in the first quarter a year ago it managed $4.7 billion, so there are your benchmarks. One factor to watch here is Rosneft, where BP has a 20% stake, as the Russian business contributed $555 million of earnings in the fourth quarter last year, and BP has now committed to divest that holding. After that, shareholders will look to 3 more figures. The first is capital expenditure. BP has outlined a budget of $14 to $15 billion for 2022, compared to $12.8 billion last year. The firm is keeping a tight rein on spending, and it's unlikely to lead to much, if anything, by way of an increase in hydrocarbon output. Environmental companies may be pleased. Householders fretting about their heating bills and the cost of running a car may be slightly less enthused. The second is the dividend. BP cut its quarterly payment in half in early 2020, but has since nudged the run rate to 5.46 US cents a share. The oil major has also bought back $2 billion of stock in 2021, and it outlined plans for another $1.5 billion in buybacks for the first quarter of this year alone. It'll therefore be interesting to see how much more there is to come. And the third figure that will be watched is net debt. BP has slashed its net borrowings by 40% from Q1 2020's peak of $58 billion to just over $30 billion. Careful capital investment and higher earnings should boost cash flow and give the firm scope to further reduce its liabilities should it so choose. And shareholders will be looking at how BP elects to allocate capital to the best effect going forward. Finally, shareholders and analysts will look out for any impacts of Rosneft and BP's planned withdrawal from Russia upon the accounts, and any further strategic updates on the company's long-term strategy to reposition itself for a renewable energy-based world. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you next time.